Let's go ahead and get started. So welcome everyone to today's webinar. I'm Pat Soldano, President of Family Enterprise USA and Policy and Taxation Group. We advocate for generationally owned family businesses and their lifetimes of savings. At a national level in Washington, D.C., we represent all sizes and all industries of family businesses around the United States, as well as successful individuals and family offices. So thank you for joining us for this webinar today. The title of this webinar is How Do You Future Fit Your Shareholders' Liquidity Strategy to Avoid Disruption? And this topic is one of the biggest disruptions of family-owned companies, is this lack of clarity regarding shareholder liquidity. This webcast will examine leading practices for creating a liquidity strategy and plan that balances the short-term and the long-term capital needs of your business and your family as they continue to grow. The webcast will cover common liquidity alternatives and options, the design of a dividend policy, and financial modeling required to support the elements of a shareholder liquidity plan. So I'm very pleased to have with me today Sean Aylward, who is Managing Director, National Tax Department Succession and Generational Wealth Transition at EY, and Dom Venente, who is Manager, Family Enterprise Business Services at EY. So thank you both for joining today, and I'm going to turn it over to Sean to start the webinar.
Okay, great. Thank you, Pat. It's great to be here today. Very honored to join you on this important topic. I'm joined with my colleague Dom. We'll walk through a presentation today. I'd like to start just with our learning objectives and quickly review what we're going to cover. We'll start first. We'll discuss leading practices for designing dividend and distribution policies for family operating companies and their trusts that may own them. We'll look at the key factors that need to be considered by the family operating enterprises when developing their liquidity policy. And then we'll also touch at the end on what trustees need to consider for purposes of developing a distribution policy for the assets that they're serving as trustees. I want to thank everybody in advance for providing some questions with their registration. The questions were great. We hope that the presentation itself will answer most of those questions for you. We will reserve a few minutes at the end for questions and answers if we get time to get through that. Please put your questions in the Q&A button at the bottom of your screen, and we'll do our best to get those at the end. Hopefully, we'll get most of them covered by the presentation, and look forward to answering any other questions that may remain. So let's quickly start off with sort of our approach from how we think about family business. And we look at it as if it were DNA, right? So that the family and business are intertwined like our DNA is intertwined, and that the business and values of the family intertwine. Most of the family enterprises that we work with, about 90% of them, their net worth comes from the family business, and about 90% of the income is derived from the business. So it's a substantial asset for the family. And you'll see here that we have family and enterprise intertwined in the beginning. We really believe there are 4 core strategies that each family enterprise has to develop to be successful and to minimize disruption. And you'll see those being business growth, company capitalization, generational transition, and shareholder liquidity. And you'll see surrounding in the helix are the 8 strategies that sort of support those core strategies the business needs to have. Today, we're going to focus on shareholder liquidity. They're all intertwined, and that's the purpose of this slide, to show that. When we think about shareholder liquidity, it impacts business growth, it impacts company capitalization. So keep that in mind as we go. We may touch on that a little bit, but today we'll focus primarily on shareholder liquidity. And as we move to the next slide, one thing we notice and what we're trying to balance when we think about stakeholder liquidity and shareholder liquidity is most middle market family-owned enterprises sit in the first generation, so about 70%. And you'll see that about 15% of them can move to generation 2, about 12 make it to generation 3, and about 3% make it past generation 3. However, we find that if you can get to the upper middle market, which we'll define somewhere in a neighborhood of about approximately 300 million in revenue, you'll see that the likelihood of successful transitions down through multiple generations and beyond generation 3 goes up substantially. And in the upper middle market, almost 40% of those companies make it to the third generation or beyond. So with a good shareholder liquidity plan, we're trying to balance the desire to grow that business to become larger and more valuable so that it can become successful in making its transitions through multiple generations against the desire to distribute funds out of the business and take that away from potential growth and distribute it out to the stakeholders. So that's the balance we're trying to achieve here. So we'll walk you through those key considerations as to how we might find that balance for your particular family business. So moving to the next slide, you'll see that really the successful long-term businesses have to balance their ongoing growth and minimize disruption. And it's really these 4 core services that drive the ability to reduce disruption. And we'll talk today about the potential disruptions that could arise in the shareholder liquidity context. And Dom, I'm going to ask you to talk about the 3 things we see right now that are starting to create some pressure from a shareholder liquidity perspective.
Absolutely. Thanks, John. So really, there's 3 factors that are increasing pressure on family enterprises to distribute increasing amounts of liquidity outside the enterprise itself. This is leading to increased need for clearly defined and communicated liquidity strategies to avoid potential disruptions, like Sean said. The first of these factors is what we call the transition wave disruption. So over 60% of CEOs, presidents, or principal owners of family enterprises are over the age of 61. And with this transition wave, we are seeing an increasing need of pressure building upon the enterprise itself for liquidity as it relates to the transition of these leaders of enterprises. What does that mean in terms of potential redemptions of their shares as they transition outside of the company itself? What do their ongoing lifestyle needs look like? So this just being the first significant liquidity pressure that we're seeing with older generations and leaders of family enterprises seeking to transition outside of the business itself.
And Dom, what we're seeing is that this could be for lifestyle purposes. It could be to fund retirement. It could be to fund healthcare costs. You mentioned estate taxes. That's a big one. Redemptions associated with that. So this transition wave is underway, and over the next 10 years, will have a significant impact on operating businesses.
The second factor is what we refer to as the personal wealth gap. So in connection with that transition wave, as ownership moves from one generation to the next, what we call the personal wealth gap typically grows in line. So for instance, as we see on this chart, in G2, what we refer to as the personal wealth gap being the difference between assets that are illiquid versus assets that are liquid in the company is a 20%, 80% breakout. However, as the family enterprise continues to grow from one generation to the next, we typically see that gap widen. And by generation 3, in this illustrative example at least, 90% of those assets are illiquid and 10% are liquid. As it relates to how this applies to, again, those factors that are increasing pressure within that enterprise itself, as that paper-rich, cash-poor trend continues, we're seeing increasing amounts of pressure on the business itself for liquidity to tap into that what's currently illiquid wealth held within the family enterprise itself.
And Dom, and as that ownership changes, whether it's direct ownership or indirect ownership, the number of stakeholders increases, right? So the current distribution policy that the company maintains may not be sufficient to satisfy the needs of that new class and ever expanding class of beneficiaries. So, we expect that this will certainly cause a demand for additional capital come out of the business.
And the third major factor causing increasing liquidity pressures is the just sheer number of increasing numbers of inactive owners and beneficiaries that happens over the course of time. as it relates to a percent of those who are active versus those who are inactive. And active versus inactive owners and beneficiaries, complicating that even further, often have opposing needs relative to whether it's income or realizing and tapping into the value of that enterprise itself. So to dive into each of those a little bit, on the active side, we have people that are working day to day at the business, understanding the strategy and risk and the potential outlook of the company. Those that are closer to the company often embracing a longer term stewardship type mindset. And aside from any formal liquidity policy or strategy, they're the ones that are likely receiving income from employment or potentially other perks, and are more likely to want to reinvest earnings back into the business. On the inactive side, we have individuals that may be either entirely or largely dependent on potentially ad hoc dividends coming out of a company for employment and for their own lifestyle needs. Again, tied to the personal wealth gap, they may be the ones seeking for a realizable high value of the enterprise itself. There may be external pressures from the wealth management industry to diversify their illiquid holdings into other types of investments that may be more liquid and have different types of return profiles. And unlike the active owners, given these factors, they may have a shorter term outlook, aren't receiving these types of perks from the business, and given the confluence of all these factors, are more likely to pressure the company for either increased funds and pools available for redemptions or increased amounts available for distributions.
Yeah, Dom, I think that's right. I think the combination of these three factors is likely to increase the pressure on companies to distribute. I think a well-defined, well-articulated, and well-thought-out distribution policy or liquidity policy sort of acts as a relief valve, right? To relieve some of that pressure. It won't relieve it completely, but it helps to relieve that pressure and reduce the potential for disruption. So let's talk now and move now that we know sort of the landscape and the potential disruptions out there, and some of you may be experiencing these already and have the aha moment that it's likely to happen at some point in the near future. Let's talk now about some of the key considerations that you should be thinking about as we begin to think about defining and preparing a liquidity policy. Let's start with sort of the goals and objectives. So the goals are pretty straightforward, right? We want to preserve family legacy and multi-generational wealth that's been created and likely to be created in the future. We'd like to sustain the private ownership of the business for future generations, right? So we want to grow those larger, more valuable businesses for multiple generations into the future. But we also want to address those evolving liquidity needs of the family, right? As we have a growing base of stakeholders, the liquidity needs grow. So we need to be able to balance those against growth of the business and satisfying those liquidity needs. So to do that, the objective of the process really needs to be to understand what those long-term needs are and how it impacts our existing liquidity policies. We need to then define and then organize the long-term shareholder liquidity needs. We need to understand what those are going to be and plan for those, and at least estimate what they might be. And then we need to align our perspectives from a wealth preservation and a business growth perspective with our stakeholder base and make sure everybody's in agreement as to what's the proper approach and what's the proper balancing of how to balance those two competing needs. So Dom, tell us a little bit about how that balancing is and what's at stake.
Sure. Like Sean said, what we're trying to achieve here is finding that balance, and it's the balance between the business needs and the owner needs. So on the business side, there's needs for working capital. So what does the company require for its ongoing operations, capital investments, corporate development? What does its growth plan look like? And what are the capital requirements going to be needed to fund that organic, inorganic growth plan? On the flip side are the owner needs. So when we think about the different generations, we have older generations that may be seeking reward and security or increasing needs for redemptions as they think about transitioning ownership. On the younger side, we have younger generation, their development, potentially education, lifestyle, housing needs, those types of items. And then in between, there's taxes and estate costs that need to be funded, likely with business capital. And importantly to note here, what we find is management of family enterprises are often keenly aware and in tune with the business side of this equation, but it's the owner needs that can be likely more opaque or fuzzy and might not have been clearly defined. And these are the types of things that are never really going to show up on a GAAP balance sheet, for example.
Yeah, John, just think about it. A well-defined growth plan by management that's talking about reinvesting in the business, acquiring businesses, continuing on the growth strategy. If that management team's not aware what the potential family needs could be down the road, those plans could be scuttled, right? If all of a sudden a significant portion of capital has to come out to the family to meet an unexpected need of the family or even an expected need of the family. So we think aligning those two analysis together is really important, and starting to think about that now so that you can plan it out over a timeline as to where there may be gaps in available liquidity to satisfy both sides. So that's the sort of starting point. And these are the stakes, right? That single pot of money in the center has the competing demands of both family and business.
Exactly. So next we'll spend a little bit of time kind of diving into each side of that balancing act, starting with the family side. One tool that we find can be helpful and shed some light on, again, what could be this fuzzy side of the owner needs is a family demographics chart. So what we're showing here is simply 3 generations of an example family enterprise and a projection of their ages out over the next 20 years. This tool can be useful in identifying potential pinch points or where potential increases for liquidity needs might come from that owner side of the equation and increase pressure on liquidity demands from the company. So as we think about people entering various stages of life, we think about different owner needs, whether it's retirement, redemptions, again, housing purposes, education planning, growing families, and what does the capital requirements of all that look like simply from the family side of the equation.
Yeah, and this
So
type
Dom,
whoops, sorry, go ahead.
go
Pat,
ahead.
sorry.
I was going to interject a question, but I'll let you go ahead and talk,
I was
Sean.
going to say this type of chart can be very helpful to identify the timeline. And what you would do is show in different areas where there might be pinch points or where there may be people entering certain stages of their lives where there might be increased needs. So you can begin to forecast what that might look like. So in 5 years, we may have a group of people retiring or may be entering an age where they have increased health costs. And then we have a group where their children are getting married or they need to go off to college. So you can start to plot that out on a timeline, give some estimate of potential value to what that might be, and start to think how that balances against capital. So Pat, I cut you off. I'm sorry. Was there a question you were going to raise?
Well, this may be a little bit too much in the weeds, but as you've been talking about the family demographics and how important it is to determine what the distribution to family members is going to be, executing on that is difficult, right? So I'm sure you found many families have a variety of distribution policies. And typically, depending on the structure, legal structure, it has to be consistent from family member to family member. So maybe you could share with us, is every family different? Is there any consistency or rules around policies, how families should execute that policy, meaning get a family meeting together or the family council together and determine it together, do it independently, rely on outside sources? I mean, share with us a little bit around how does it really happen?
I think, Pat, it's a little bit of all of the above. So there is no clearly defined single gold standard liquidity policy that would apply to every single family. There's no one size fits all solution. What we have is a process, right, that we recommend people go through, starting to identify. This slide helps us begin to identify family side. We're going to talk next about how to identify the business needs. And we'll talk through some of the tools that are available, right? Because often people talk about dividends, but dividends is only one of many different types of liquidity policy tools that we have available to us. And not every tool will be applicable to every family or to every family member, right? And we'll talk when we get into those alternatives, the difference between dividends or redemptions. Dividends may not be great for certain types of entities because of tax consequences from entities, but it is a very fact-sensitive and policy statement that needs to be developed, and we do recommend that it's a combination of the family as well as the management of the business, right? They're not always the same people are involved, so that the decision is a reasonable balancing of, again, the desire to grow a larger, more valuable business, but at the same time, make sure that the owners, whether they're direct or indirect owners, given all the trust we have in structures, they may be just beneficiaries of a trust that owns the shares, but that they feel like they're receiving something for their equitable position in the company. So it's a balancing. We'll walk through how we approach the balancing and how, but again, it's very specific to each family. There'll be some common principles that apply to everybody.
Just to add, Sean,
Right.
there's, again, between the family and business side, there's also the lens of the quantitative versus the qualitative, and that's where a lot of the differences come in. We'll talk through some benchmarks and metrics around the quantitative side of things so we can get kind of a frame of reference, but it's things like family preferences, family desires that are always going to be the unique dynamic, in addition to the legal structures, like you said, Pat, that are going to need to be taken into consideration.
Makes sense. Well, why don't you now talk to us about the considerations from the business perspective?
Yeah, great. So as you can imagine, the liquidity policy is dependent, or will be dependent, right, on the forecasted cash flow. That's the pool of money, if you recall from the prior slide, that sat between the two sets of hands. It's the forecasted flat cash flow. What will be available for potential distribution out to the stakeholders? So there are really three key components to defining that. Looking at first the historical performance of the company. You know, how has it performed over the last 5 years? How do we anticipate it's going to perform over the next 5 years? Has there been volatility? Do we expect volatility? What's the competitive nature of our market? Then looking at capital structure as the next phase. You know, what is the current fair market value of the company? Are we growing? Is the value increasing? Are we in a declining period and we're recovering? We need to understand our current debt obligations so that we can properly service our existing debt. You know, do we anticipate we're going to be needing additional debt for purposes of funding our growth plans? And then what's the need for cash throughout the cycle, right? Where are we in the business cycle? Are we a growing business that's required to invest more in the business? Are we a stable or mature business that our need to reinvest is not quite as great? Or are we at the end of our cycle and that we begin to wind down operations and move towards a different type of business operation? And then finally, thinking through just capital expenditures, right? What is allocated for purposes of capital expenditures to grow the business? Are we in a period where there's heavy CapEx demands? We need to retrofit our manufacturing facilities. We need to expand our footprint. How have we planned for significant projects? Are we entering a acquisitive phase where we might be doing mergers and acquisitions over the next couple of years to supplement the existing business? And then one that we saw quite a bit as companies came out of COVID was deferred expenses. You know, many businesses at the time really battened down the hatches and delayed expending money more than was necessary to maintain the business. That now needs to be made up, right? There's deferred maintenance, there's additional CapEx and other expenses that may need to be made. So those all need to be figured out and understood. And much like the family side, where we thought through what those expenses might be, when they might occur, and how much they might be, we would do the same thing for the business. We would identify these potential expenditures and cash flow items, create a timeline for those, and estimate what they might be from a dollar impact perspective. Really, the goal here is to get to sort of one version of the truth as to what we think the future is going to look like, so that we can come up with a reasonable approach to balancing the needs of the business and the family.
Yeah, I think that's exactly right, Sean. There's never going to be a case where all the needs can be satisfied. So just trying to come up with a rational, fact-based method for allocating what's likely a limited pool of funds towards those various needs.
So Pat, I think this goes to the next topic goes to your question, which are the various alternatives that can be considered for purposes of the liquidity policy. And we like to think of this as a policy, right? It should be a written policy that identifies, the company's point of view on what the liquidity pool should look like and how it should be distributed. The first, they're dividends, right? That's the first one that everybody goes to. It's the easiest of comparisons to other publicly traded companies, right? You can look at the S&P 500, see what the dividend payout ratio is. Dividends, though, and you alluded to this in your question, are not always great, right? They need to be made generally pro rata. They do not take into consideration necessarily the individual needs of the shareholders, right? We may have one shareholder that needs the liquidity and therefore wants the dividend to be paid. We may have another shareholder that doesn't need the money, would rather see it invested in the company and to grow the business long term, and is comfortable not taking a current distribution and just reinvesting it. So the dividend is we see very common in a liquidity policy, often some sort of small or starter for purposes of creating some liquidity. It also can be done in a special dividend where we set a minimum dividend or some formula-based dividend on an annual basis, but give the board of directors authority to distribute a larger dividend if the circumstances, maybe there's been a nice year of performance, there's extra free cash flow available, maybe we've sold off an asset or a division and there's free money that doesn't need to be reinvested in the business. A special dividend would be a great way to get that money out to the shareholders. Not going to touch on all of these, but I wanted to cover a couple of others. The next one being a redemption pool. This was mentioned in the questions. A redemption pool is a policy where the company sets aside a certain number of dollars on an annual basis and gives the shareholders the ability to redeem their shares. So to turn shares back to the company in exchange for cash. This solves the problem I alluded to with dividends, right? This gives those shareholders that need the cash now the ability to turn shares in. They reduce their equity position, but those that don't need the money don't have to take advantage of the redemption pool, and they continue to have their ownership intact the way it was. So we see redemption programs and pools adopted as part of a liquidity policy. Another simple way to do it is for the company to lend money to those shareholders who have a liquidity need on a short to midterm basis and allow them to repay those loans in the future out of potential dividends and distributions. That can be done on a very tax favorable basis because the interest rates that are allowed between related parties are lower than what the current market rates might be. So that we see that as part of the program as well. And then finally, I'll touch on internal recapitalizations. What we're talking about there is really recapitalizing the stock and creating preferred and common. And the preferred would carry a dividend. So for those shareholders that were more interested in receiving annual distributions, they would choose to take the preferred stock, giving up or all or a portion of their common stock, which is what shares in the upside and growth of the company. Whereas those shareholders are not as much interested in maintaining a annual distribution, they'll keep the common. Would you be able to do this with an S corporation? There was some questions about the difference between C and S. S corporations can only have a single class of stock, the only difference between those being voting and non-voting. So if we start to change economic interests, which this would do, that wouldn't be available for an S corp. And just like dividends have a difference between S corps and C corps, the dividends for a C corp are subject to a second level of tax on receipt by the shareholder, and that's why they're not tax efficient generally. That doesn't necessarily mean that they're not paid. It just is not as tax efficient as some of the other options. Tom, you want to talk a little bit about a couple of the external ways to raise cash available for liquidity purposes?
Sure. So aside from internally generated free cash flow to fund any of these liquidity options, family enterprises have a range of solutions to fund these various options. So whether it's debt, equity, or strategic solutions. Oftentimes we find it's debt solutions that are most closely aligned with the long-term ownership goals of maintaining family ownership. However, equity solutions do exist, and there are equity providers that can be more aligned with the interest of a family, but typically we see the equity solutions only for larger, maybe one-time or significant liquidity events. And then lastly, we have strategic options, whether that's split up, spin-offs, strategic partnerships, or other sales of the company or assets that can be used to generate capital to fund the liquidity solutions.
And as you mentioned, what we see with family enterprises, there's a preference not to have outside investors, right, outside of the family. So these equity sources are, far and few between. That's why we focus primarily on free cash flow. The companies generally prefer to make their distribution decisions based on what's available cash being derived from the business rather than looking to outside sources. And even from a debt perspective, we find companies are often debt adverse, certainly for purposes of creating distributions to shareholders. So it's really driven off of the free cash flow that's coming from the business.
So Sean, you, before we move on, you had talked about the dividends and the possibility of using those dividends as for distributions and the pros and cons. One of the questions was, how do we think about the ratio of profit paid out in dividends relative to capital reinvest in the company? I would suspect that that is unique to each individual situation, but can you address that a little bit?
It is, and Don, we probably can jump a little bit ahead and skip the next slide, and we'll come back to it because we cover this. As Don mentioned, there are a number of benchmarks. One of the questions we always get is, what is everybody else doing? Where do we stand? What's their recommended? It is very specific to your business, but the next two slides talk about two external benchmarks that we often see, or at least review, when determining what would be acceptable. Remember, at the end of the day, we want a policy that's reasonable and well thought out and can be defended, right? Because the stakeholders and shareholders may question, well, how did you arrive at what amount you're willing to distribute, and how does that match up against what other people doing, and how can it be benchmarked? So Tom, tell us about the first of the two benchmarks that we often see looked at.
Sure. The first is the dividend payout ratio, which is simply dividends divided by net income. So Pat, I think this is starting to get to the heart of your question. And what we're showing here is just simply a range of payout ratios in 4 buckets: low, moderate, high, and ultra high. The low bucket being 0 to 30% of net income being paid out each year. And companies that fall into this bucket are typically those in more of a growth phase that require extensive reinvestment, might be early stage, very high growth, and have positive investment opportunities. As we move up the scale, companies are typically becoming more stable with moderating growth rates. So in that moderate bucket, being the 30 to 60% range, we have companies that are stabilizing, moderating, still have reinvestment opportunities, but are finding more of a balance between reinvestment and distribution. And then once we get into the high range, so think over 60%, but less than 100, those are companies that are typically in very mature industries or very mature companies with limited reinvestment opportunities. So they may be looking to dividend out or distribute more income for owner diversification type purposes. There are certain industries that allow for payouts greater than 100%, but typically companies that are routinely paying out more than 100% are going to be what we classify as unsustainable territory. And if we think about just a broad index, so the S&P 500 being a typical benchmark people look to, the average payout ratio of that index over the last 10 years has been around 42%. And we also track an index of large publicly traded family-owned companies or public companies with significant family ownership. And we find that index typically falls in the 25 to 30% range. So again, back to kind of the theme that we talked about before, that no one size fits all policy. generally speaking, for family enterprises, we find that they fall slightly on the lower side of the scale with respect to any given industry type. Anything else to add there, Sean?
Just reinforcing that this is really a benchmark that's used and focusing on the particular client, where they sit in the maturity cycle and where they are from a reinvestment perspective, right? The growing businesses typically need more reinvested, therefore the dividend payout ratio is on the lower side. And we see, as you said, sort of a skewing towards that, with family businesses focused on growing those larger, more valuable businesses to keep for multiple generations. So we have a second benchmark we typically use as well. Tell us about that, Tom.
Sure. Second benchmark is the dividend yield. So calculated as the annual dividends per share divided by price per share. Similar ranges we showed here: low, moderate, high, ultra high. So in the low end being 0 to 2%, moderate 2 to 4, high 4 to 6, and ultra high anything typically greater than 6%. Referencing back to that index of large publicly traded but family-owned companies, we present down on the bottom here what percent of companies of that index fall within each of these ranges. So at the 0% end, 26% of these family-owned companies are actually not paying any dividends at all. 27% are in the 0 to 2% range, 29% 2 to 4, and then the remaining less than 20% are paying over 4%. And again, thinking back to broad industry benchmarks, the S&P 500 falling at 1.9%, and similar to the dividend payout ratio being slightly skewed to the left, the average of these families in this index is typically in the 1.5 to 1.7 range.
So Dom, we have a question from David Rothberg, and he says, is this for all dividends or all distributions, including buybacks?
This data does not include buybacks, so this data we're showing here is just total dividends paid. So again, like Sean said, dividends being one component of the overall plan. And certainly I think one of the reasons why families may skew slightly to the left is because there are a lot of those alternative liquidity solutions Sean talked through, in addition to what might be a stable, kind of consistent dividend as part of the foundation of that framework.
Yeah, so Pat, you might see that the company does their analysis of free cash flow and decides that there may be $10 million available for distribution. They may allocate a portion of that to the annual dividend and the balance of it to a redemption pool that would be conducted on an annual basis, let's say. I think the question goes to another issue, which is, again, forecasting out these unexpected redemptions, right? The shareholder agreement may require a buyout of shares upon death of a shareholder, or disability of a shareholder, for example, two common planning techniques that you might see in a shareholder agreement. Those are not necessarily predictable, right? We're talking here about a predictable annual liquidity policy. I do think there needs to be built into it some flexibility to deal with these sort of contingent liabilities that sit out there but are not shown on a balance sheet anywhere, or a financial statement that sit out there. So I think it's a very good point, but it does need to be figured in. That's why we see, I think, the company ends up typically keeping more cash or access to debt in an event those bigger redemptions or bigger liquidity events come along. Could be an estate tax that causes the redemption, to sort of have a war chest, so to speak, to help with that. So that's why I think we see some of these percentages on the lower end. Any other questions, Pat, on that?
No, not so far. We have a question that I want to hold till the end because it's a little off topic. I want to make sure that you get a chance to get through all your slides.
Okay, good. So let's go. So the next, and what we recommend is really doing some scenario-based modeling to get a general idea of where the company sits and what their projected cash flow might be, as well as what the family's needs may be, excuse me, and what other assets the family may have available to them to satisfy, right? As I mentioned, for most family businesses, about 90% of the net worth comes from the business, but not all of it, right? And as distributions are made and investments are diversified, the available liquidity from other types of investments may also solve partially the needs that the family has. So the key drivers for this model would really be, as we talked about, understanding the business side of the equation, then understanding the family side, right? What are the long-term vision and goals? What's their risk appetite? How are future dynamics going with respect to new generations becoming involved with the business? But then there's also the external factors that need to be figured into the model. And those would be, macroeconomic events, what's happening in the market currently, industry forces, what's competition like in your particular industry, right? There has to be reasonable assumptions as to all of those. I think one that's a big one that we're all experiencing now is the increase in interest rates, right? After a very favorable interest rate environment, interest costs are up, inflation is up, which is causing ripples through our businesses. So what we like to do is think about a scenario-based model where we put the inputs in as to the operating business's performance, the jointly held family investments performance, and then the individual investments performance, and do some scenarios, high, low, and middle as to performance. Model in acquisitions, model in increased debt service, model in high, low, and medium performance for investments, and run a number of scenarios to determine what sort of are the parameters under which we can operate. And then I think that model has to be a living, breathing model that's updated and revised and corrected along the way as those assumptions either prove out or change, right? There are a number of things happening. As I said, interest rates have changed dramatically over the last couple of years. Any model that was done 2 or 3 years ago would have faulty interest rate assumptions and inflation assumptions in it. Investment returns are fluctuating, as we all know, on an annual basis. And operating costs for the business have gone up in many industries. So those all need to be periodically checked. The model should be updated. And the results obviously will have an impact on the liquidity policy. And that's why, as I mentioned earlier, it's really a living, breathing policy document that needs to be updated and needs to reflect what's happening and what's realistic. And it needs to be, carefully documented that this is a policy. It's not necessarily a guarantee. There may be years where the company's not in a position to make a distribution because of a number of factors have affected it, and it's going to withhold and batten down the hatches, so to speak, with regard to the business. Family has to understand that, know that, and there may be an opportunity to do a catch-up later, but those are the type of things that go into the modeling. So I think that brings us past these 2 slides and sort of to, now that we know both the family side's needs and the business's needs with respect to capital, thinking through the framework for purposes of designing the actual policy statement itself. So a number of things to keep in mind when sitting down to do that. First, there has to be a balancing of those needs and expectations and a commitment to the family business as a long-term family wealth creation engine, right? That larger business for multiple generations is the goal, assuming that's the goal, and aligning with family stakeholders that is the goal is critical. You need to take a long-term view towards the benchmarks and towards performance, and make sure that that's adequately considered in the model. It should create a cash buffer for market shocks, both for the business and the family, so that if those shocks occur, both the business is in a position to protect itself, and so is the family. There needs to be an allowance in the policy to allow for upside performance. So if we have a really good year, we exceed the performance estimates that we had, that there's a provision in the policy that allows the board of directors and the family to make a decision to distribute more than what the policy might say. And then, importantly, as we move from generation to generation, the policy really has to take into consideration that there will be a growing number of stakeholders that are sharing in this pot, right? The hands from the family side will be continuing to grow, and those expectations for access to capital need to be considered as well. Tom, you want to tell us about some of the variables and things that need to just be periodically checked on and updated as we
Sure.
think about this?
So Sean talked about what the liquidity policy is trying to achieve. On the other side, we hit on a few of these when we talked about the modeling, but it's the factors that are going to affect whether it's business performance or just overall availability of liquidity to fund any sort of liquidity policy in any of the strategies we've outlined. At the end of the day, again, we're trying to create a policy that's flexible with room to adjust over time to internal and external factors that gets reviewed and updated over time as these internal and external conditions may change. But just to reinforce some of the point again, it's growth versus preservation of wealth expectations. Again, that's going to be unique to every family. We have the business items itself, performance, cost, returns of the business, external market conditions, like Sean said, rising inflation, interest rates, how is that going to adapt over time? And how do we need to think about how our liquidity policy should be adaptable or flex to those types of changing events? Other macro events that we can't even predict that might be down the road, how do we build in reserves or buffers or mitigate potential risks of future disruptions? Then there's always, again, tax policy, charitable giving, preferences of the family in that regard, all different types of considerations that, again, this isn't going to be a policy that's set it and forget it. These are the types of things that are going to need to be monitored over time as the liquidity strategy evolves.
So
Yeah,
Sean and Dom, we have about 10 minutes left. And so I want to make sure that you get through all the information that you would like to cover. And I know you've talked about liquidity needs for the business as well as for the family. Maybe you can share with us some of the other liquidity, shareholder liquidity issues that multi-generational family businesses should be thinking about.
Yeah, thank you, Pat. And we're sensitive to the time as well. So as many of you may experience through some really good estate planning and generational transition planning, oftentimes there are holding companies and or trusts in the ownership structure. So the decision for the company to make a distribution, whether it be in the form of a dividend, a loan, or a redemption, for example, oftentimes the proceeds end up in a trust, right? So the trustees of those trusts may not be the same people that ultimately made the decision to make the distribution from the company. So there needs to be a second level of decision making by the trustee as to whether and to what extent they should distribute the funds they've received from the company out to the beneficiaries. So we thought it would be helpful to sort of review some of the principles around that decision and our recommendation that not only the company have a liquidity policy, but that the trusts and the trustees of those trusts develop a distribution policy so that when they make decisions under their trust instruments, that they are well thought out, they're reasonable and can be defended, so that when they make those distributions, if they do, to their beneficiaries, they feel confident that they've met their fiduciary duties to the beneficiaries of the trust. So we'll walk you through a little of those, some of the issues that come up there, but we find this more and more that the decision about liquidity is not limited to just the business. There's usually a number of gates that the funds have to flow through before it gets to the ultimate beneficiary of those funds. And you can see how this might cause problems, right? If we had, for example, multiple families that owned a business and a decision was made to distribute money out of the business to the various branches of the family, but one family decided that they were going to withhold all that money in the trusts and not distribute it out to the beneficiaries of those trusts, you could see where you might start to have some conflict between cousins, let's say, that are receiving distributions out of their trusts and cousins that are not, right? So understanding that landscape and how to sort of balance that is important, I think, in any liquidity discussion. So let's just do a little background on trusts and why trusts are such a big part of ownership of family-owned businesses, right? So you really have two choices about how you transfer assets. You can do an outright transfer. You can just give ownership of the asset directly to the beneficiary, no trust at all, right? Those assets are transferred by gift or inheritance. There is no investment oversight over those assets once they get to the beneficiary. They are subject to the spending habits of the recipient. They're subject to the claims of creditors of that beneficiary. And they're taxable, right? They're includable in that beneficiary's estate when they pass. So over the years, trust planning has become a very popular way of solving some of those sort of non-tax concerns, right? If I put assets in trust, I can limit them from the claims of creditors. I, if properly drafted, could prevent them from being subject to estate tax when the beneficiary dies. And I can put people in place that may be better suited than the beneficiary to make investment-related decisions, to make distribution-related decisions, and I can protect those assets for a longer period of time. So we've seen a big uptick in the use of trusts that hold assets in family-owned businesses and then hold the cash and other distributions that come out. Typically, those trusts have distribution provisions that break down into two components. A discretionary distribution standard, which allows the trustee to distribute in their sole discretion. The alternative would be a distribution that's subject to a standard. And what we summarize here is sort of the types of trusts you might see. And we're really focused here on the right side of the column, which are irrevocable trusts. Those are usually completed gift trusts. Those are intended to maintain their existence for many, many years. They're often called dynasty trusts or multi-generational trusts. And they are intended to go through, current beneficiaries and into future beneficiaries. So children, grandchildren, great-grandchildren, etc. And as I said, there's two different distribution standards. There's the mandatory distributions. Those are pretty simple, right? At age 35, distribute 1/2 of the balance of the trust. At age 40, distribute the balance. There's not a lot a trustee needs to be concerned about when there's mandatory distributions, right? They're obligated to follow the terms of the trust. It's when we have distributions that are discretionary that can cause some concern, right? Because a trustee serves in a fiduciary capacity for both the current beneficiaries and for future beneficiaries, right? So I may be the beneficiary of a trust for my lifetime, and then on my death, my share continues to be held in trust for the benefit of my children, right? My trustee owes both me and the future beneficiaries of fiduciary duty. So there needs to be a balancing, just like we have a balancing of how we balance the family needs and the business needs when the corporation makes a decision. The trustee needs to balance my interest versus the future beneficiary's interests and come up with a reasonable way to distribute. And what we've seen is an increase in the use of an ascertainable standard. This is a concept that comes out of the Internal Revenue Code, but it helps the trustee understand how they might be able to distribute. And the standard is really for health, education, maintenance, and support. And it's come around because there's been a desire, to include either related parties or the beneficiaries themselves as trustees of their trusts. So to avoid some adverse tax consequences, this health, education, maintenance, and support standard came up, and we're seeing it more and more in trusts. It's hard for a trustee to understand whether a particular distribution meets that standard. So we thought we'd sort of talk through that with you and give you an idea of what that may look like, and talk about, much like the business, what distribution decisions have, what type of impact the distribution decision has on a trust. So Don, why don't you walk us through sort of this idea of how trusts make distributions and what the impact might be?
Sure.
I
Yeah.
just want to, before Dom starts, I want to make sure we know we have 5 minutes remaining.
Yep.
Yep. We'll move quickly through this. So we have some assumptions here for a trust. Again, thinking through Sean's point on current versus future beneficiaries, a trust with $100 million principal balance. One example of thinking long-term and balancing those needs is think about how some of these assumptions may change over time. But again, thinking through this specific example, we show a range of change in trust principal that could result from different distribution percentages. So again, $100 million trust, given these assumptions, if it distributes 3.71%, there's going to be no change in trust principal over 10 years. The interesting thing here is just changing this one variable slightly, 1 or 2% either way, has a significant impact on overall trust principal in that 10-year period. So a percent or two down leads to 13% growth of that balance, and a couple percent higher leads to a 30% decline in the overall trust balance.
Right. So if a trustee is making decisions about current versus future distributions, and this trust is intended to last 100 years, right, they need to balance the desire by the current beneficiaries to take distributions against their fiduciary duty to those future beneficiaries. So very helpful, Dom. Let's talk. I just wanted to point out, these will be in the slides that we circulate. The roles, and we're really focused here on the trustee's responsibilities from a distribution perspective, which is the far right column. I've also included a couple of slides on this health, education, maintenance, and support standard. Even though that's an internal revenue code concept, it is defined by local law. So it's defined by the law that governs the trust instrument. So for those of you serving as trustees, if developing a distribution policy, it's very helpful to look at what your local law is for purposes of defining these categories. And you'll be surprised when you look at them, what's included and what might not be included. So, and in the interest of time, I'm not going to jump into that. I think we'll move to the conclusion and maybe open it up for a minute or two of questions. But I think the key takeaways here is that you really have to understand the business and family needs and develop what the anticipated free cash flow would be available to satisfy those needs. There is no one-size-fits-all policy for family businesses and trusts. It's very specific to your particular situation. What we find, though, is given the long-term view of multi-generational families, there's a preference towards preserving capital, allocating it to growing the business, and preserving trust assets for the long term and for multiple generations. There are many variables, as we talked about, on both sides that need to be considered. It should be well thought out. It should be documented. It should be written down. And there should be a well-defined framework as to how those decisions were arrived at, and leave yourself with some opportunity to adjust as things change and as circumstances changes, both within the family and in the business. So, Pat, thanks very much. I hope everybody enjoyed it. Happy to answer a few questions. I know we've only got about a minute or two left.
Yeah, so Sean, thank you as well. We do have an anonymous attendee who asked a question. If you can answer it in a minute, I'd do that. Otherwise, I would say these slides are going to be distributed, as you said, to all the attendees, as well as the recording of this. And that the contact information for both of you will be in that distribution email. So I suggest this anonymous attendee reach out to either one of you and ask this question. The question is really, what if the family company growth rate can't follow the family needs of the liquidity? In other words, the company will not be able to meet the goal of becoming a multi-generational wealth creation engine. What should be done?
Yeah, I think that ties into some of the other core services or core competencies we think that the businesses need to develop. I mean, I think a real close look needs to be taken at the business itself, its business growth plan. And it may be worthwhile postponing distributions and liquidity for the shareholders and focus on growing the business. There may be alternative ways. We didn't talk about all of them under liquidity planning, but one that might work here is a company-sponsored loan program. And this is a situation where the company leverages its relationships with its existing lenders and has the lenders create a facility, a credit facility for the shareholders that they can borrow against their shares, with the anticipation that ultimately those assets will be worth more money, right? The shares will be increasing in value and can be used to repay the loan. So that might be one area that jumps out. Happy to discuss that question further offline. But as Dom showed, those companies that are in growth mode and early maturity really are distributing less, if not zero, at the point to further grow the business and then get into a position to catch up with distributions later.
I think that's an excellent answer. Well, I want to thank you both for being on this webinar today. I've got some nice comments in the chat. People really appreciated it. So thank you very much. It was a lot of information, but again, we're going to distribute the slides as well as the recording to everyone. So Dom, Sean, thank you all. And for everyone attending this webinar, thank you for joining us. Have a great rest of your day.
Thanks to all the attendees and all the good questions. Pat, thank you very much to you, to Family Enterprise USA. It's been great. Appreciate the opportunity.
You're very welcome. It was a pleasure having you. Take care, everyone. Bye-bye.